Never start calculating your retirement based on some vague or ballpark figure. It could end up being way more, or worse, way less than what you actually need. Today, I'm revealing the real numbers behind early retirement and why your number is probably a lot lower than you think. Did you know that almost 2/3 of Americans actually worry that they'll be able to retire at all? I get it, with rising costs and economic uncertainty, the dream of financial freedom seems impossible for many of us. Hey everybody, I'm Mike with Roof Money Pro, and I help roofing professionals maximize their careers and build wealth. I've discovered something surprising. The conventional wisdom about how much you need is often wrong. Whether you're 25 or 45, by the end of this video, you'll have a concrete understanding on how to calculate your personal freedom number, and it's probably a lot lower than you think. Let's start with the cornerstone of financial planning, the 4% rule. Back in the 90s, there was a group of professors that put together what was called the Trinity Study. They basically looked at historical market data and came up with the assumption that if you withdraw just 4% of your portfolio in the first year of retirement, then adjust that amount for inflation each year, your money has a 96% chance of lasting at least 30 years. This simple finding gives us a powerful formula. All you have to do is take your annual expenses and multiply by 25. That's your target number. For example, if you need $40,000 to live comfortably each year, your target is $1 million. If you can live on $30,000, you only need $750,000. And if you're really frugal and you can get by on $24,000 a year, then you only need $600,000. But hold on, does this rule still work today? With lower bond yields and potentially longer retirements for early retirees, some experts suggest using a more conservative withdrawal rate of 3 to 3.5%. All we would do to adjust for that is now multiply that number by 29. The truth is, the original study was designed for traditional retirement lasting 30 years. If you're retiring at 35 or 40, you might need to be more conservative. But here's where things get interesting. Most early retirees don't just sit on a beach for 50 years doing nothing. They stay engaged, often earning some income, which dramatically changes this calculation. With that being said, if you keep a balanced portfolio and have some flexibility in your spending, the 4% rule might still hold true for even longer retirements. Here's where most people get it completely wrong. When calculating how much you need for retirement, your current spending habits are almost irrelevant. What matters is how much you'll spend after retirement. Pull out your credit card statements, bank transactions, and any other spending records. Categorize every expense from last year. Now, which of these will change when you retire early? Well, for one, your work-related expenses are going to disappear. Commuting costs, professional wardrobes, expensive lunches, and maybe even that second car you only keep for the commute. For many people, this can free up hundreds or even thousands of dollars a month. Housing costs might change too. Once you're not tied to a specific location just for work, could you move somewhere else less expensive? Even staying put, would you have time to handle home repairs instead of hiring someone? Probably so. When thinking about this, be careful about certain categories. Healthcare is the big one. Without employer coverage, you'll need a plan. For a healthy couple in their 40s, this can run maybe between $1,000 and $1,500 a month, depending on where you're at and your health condition, and last you until Medicare kicks in your 60s. Also consider travel, hobbies, and other lifestyle factors. You're probably going to spend a little bit more in these categories once you have time to pursue your passions. Here's something powerful. Reducing your expenses has a double benefit. Not only do you need less money to live on, but you also need a smaller nest egg to generate that income. Think about this. Every $100 reduction in your monthly expenses reduces your required savings by $30,000. Let's say we have a person. Let's name her Sarah. And she's convinced she needs $2 million to retire early. But after tracking her spending, she discovered that without her stressful job, she wouldn't need the expensive spa treatments, therapy sessions, and convenience services that she was using to cope. Her actual retirement budget was $15,000 less per year, reducing her target by $375,000. Let's talk about some early retirement specific challenges that traditional retirement calculators don't account for. The biggest one is accessing your money before traditional retirement age. Most tax advantage accounts, like your employer's 401k, have penalties for withdrawal before age 59 and a half. You have three main strategies to work around this. First, build a bridge account and taxable investments to cover expenses until you can access your retirement accounts. For every 5 years that you retire early, you'll need approximately 20% of your nest egg in these accessible accounts, like a brokerage or an individual account as they're called. Second, you could set up a Roth conversion ladder. This strategy involves converting traditional IRA or 401k money to a Roth IRA, waiting 5 years, then withdrawing the converted amount penalty-free. Third, you could explore the rule of 72T, which allows penalty-free withdrawals if you take substantially equal payments based on your life expectancy. Again, let's circle back to the major consideration of healthcare. Without Medicare, you'll need to budget for insurance premiums and out-of-pocket costs. The ACA marketplace can be a good option. And if your income is low enough, you might qualify for subsidies. Some early retirees even structure their withdrawals specifically to maximize these subsidies. One risk to early retirees is what's called sequence of returns risk. Basically, this is the chance that poor market performance in your first few years of retirement could permanently damage your portfolio's sustainability. To guard against this, consider keeping 2 to 3 years of expenses in cash or short-term bonds, especially when valuations are high. Finally, don't underestimate the psychological adjustment. That's a real thing. Work provides structure, identity, and social connection. Many successful early retirees continue doing some form of productive work, just on their own terms. The most successful early retirees rarely rely on just one source of income. They build multiple streams, and this creates both security and opportunity. For instance, dividend-paying stocks can provide regular income without selling assets. A $500,000 portfolio of quality dividend-producing stock might generate $15,000 to $20,000 annually. This reduces the pressure on your principal. Rental properties are another favorite. One paid-off rental home producing $1,000 monthly in net income replaces $300,000 of portfolio savings in the 4% rule. I know a few early retirees who have built modest rental portfolios of 5 to 10 properties over a decade. Don't overlook semi-passive income opportunities either. Creating digital products, writing books, or building websites can generate ongoing revenue with minimal maintenance. Even small amounts of active income can dramatically change your math. Working just 10 hours weekly at $25 an hour adds $13,000 yearly. And that's equivalent to having an extra $325,000 invested. The whole point is that each $100 monthly in reliable passive income reduces your needed nest egg by approximately $30,000. Build enough of these streams, and you might discover that you're closer to financial independence than you thought. The 4% rule is a great starting point, but sophisticated early retirees often use more nuanced withdrawal strategies to increase safety or spending. A variable withdrawal strategy adjusts spending based on market performance. In good years, you might withdraw 5%. In bad years, cut it back to 3%. This approach can sustain higher average withdrawal rates over long periods while virtually eliminating failure risk. You might want to consider the floor and ceiling method. Set a minimum withdrawal rate that covers basic needs and a maximum for when markets are strong. For instance, you could set a floor at 3.5%. and your ceiling at 5.5%, giving you flexibility while maintaining security. Geographic arbitrage is another powerful strategy. By spending different parts of the year in lower cost locations, many early retirees stretch their dollars further. Summers in Portugal or winters in Mexico aren't just adventures. They are strategic financial decisions that can reduce annual expenses by 20 to 30%. Now let's not forget about Social Security either if you live in the States. Even if you're retiring decades early, those benefits will eventually kick in. For a couple who's earned decent incomes, this could add $35,000 to $50,000 annually, starting in their 60s, significantly reducing pressure on their portfolio in later years. All that being said, your personal withdrawal rate should take in a couple of factors. your age at retirement, other income sources, flexibility in spending, and your overall comfort with risk. Someone retiring at 55 with a pension and flexible spending might safely use 4.5%, while someone retiring at 40 with no other income sources might prefer 3.5% for extra security. Location is probably the most important factor in determining your retirement number. The difference between living in San Francisco and San Antonio isn't just about lifestyle, there's some big numbers tied to it. Consider this, for example. A comfortable lifestyle in coastal California might cost $80,000 annually, requiring a $2 million nest egg. That same quality of life in many parts of Mexico or even domestic locations like the Southeast US might just cost $40,000, halving your required savings by $1 million. The same lifestyle that costs $60,000 in Boston might cost $40,000 in Asheville, North Carolina, or $35,000 in Las Cruces, New Mexico. That's a difference of $500,000 to $625,000 in required savings. Of course, relocating isn't just a financial decision. Community, culture, climate, and proximity to loved ones all matter tremendously. But understanding the financial impact gives you options. Some early retirees use a hybrid approach, spending most of their time in a lower cost location, but budgeting for extended visits to see family or experience favorite cities. That's personally a strategy that I favor. Others start in higher cost areas while their kids finish school, then relocate to stretch their savings. The key thing here is that your retirement number isn't fixed. It's a function of where and how you choose to live. We've covered a lot today, from the 4% rule to calculating true expenses, building multiple income streams, and leveraging geographic differences. The most important takeaway? Your early retirement number is personal and probably lower than what you may have first believed. Traditional advice saying you need $3 to $5 million to retire comfortably works great for financial advisors collecting fees on those assets. Not so great for all of us who are trying to get out of the rat race sooner. Start by getting an idea and calculating your true expenses in retirement. Multiply by 25 or 29 if you're retiring early. Then look for ways to optimize both sides of that equation, reducing expenses and building income streams beyond just your portfolio. Remember that every $100 reduction in monthly expenses equals $30,000 less you need to save, and every $100 in monthly passive income does the same. Most importantly, don't get discouraged by unrealistic targets. The people I know who have achieved early retirement weren't all tech executives or inheritance recipients. They were teachers, nurses, military members, and contractors, and small business owners who made a series of smart choices about spending, saving, and where to live. Your journey to early retirement starts with an honest assessment of what you really value and what kind of life will bring you fulfillment. Define that first, then build your financial plan to support it, not the other way around. So what's your number, and what's one step you could take today to move closer to it? I'd love to hear your thoughts in the comments. If this video helped clarify your retirement planning, please be sure to hit the subscribe button and stay up to date with regularly updated content. And I'll catch you in the next video.